All right, guys, welcome back to video number 6 in the option education module. And we're going to be going over Vega. This is the last Greek in this immediate module. So congratulations to getting to the end. And this one is also decently important, but I would not say as nearly as influential as Delta and Theta. But nonetheless, let's go over Vega. Let's hop onto SPY. I went ahead and load up the 40 DTE at the money call. And again, we're going over the Greeks. So let's see Vega. Vega is 0.86, and this represents the change in the options price given the percent change in implied volatility, right? So let me give you a better explanation. Vega is one of the Greeks in options trading, representing the amount of an options price expected to change for a 1% change in implied volatility. So if we go back, if implied volatility was going to go to 14.85%, which is going up a 1% move, the price of the option would gain by this Vega, right? And that is standalone, saying like Theta doesn't impact it, the underlying asset didn't move. It's just saying that this is another influence, right? If implied volatility is going to go up, Vega is a multiplier, right? So typically you see Vega influence options at different times till expiration and different moneyness, right? So factors that decrease Vega are going to be shorter times till expiration, right? Because they have less time to kind of experience that rush or decline in implied volatility. So for instance, we saw that there was a Vega at the money of 0.86. If I was going to go out to here, right? As you can see, the Vega is a ton higher, right? Because there's more time for this implied volatility to change, right? That's essentially what it's saying, right? So the closer to expiration, the less Vega is, right? Now, and again, I'm reading notes off my phone because Vega is a little bit difficult for me to remember as well. But factors that are going to also increase or decrease Vega is going to be moneyness, right? So at the money is going to be an increase in Vega, and then anything away from that is not going to really feel the effects. So now that I got that down, let's take a look. We'll go back out to the 40 days, right? And just a little quiz. This is going to increase the Vega because it's further out money, or further out time-wise, right? Now, if we go way out the money, we see Vega is 0.54 versus here, right? So Vega has gone down because we're way out of the money. And if I go in the money, right, so in the money here, Vega has also gone down. So Vega is really going to be the highest when it is farther out time-wise and closer to the share price, right? So when the strike price is closest to the share price, so at the money, it's going to be the highest. But kind of talk about implied volatility and what it is, because I kind of just talked about implied volatility, but I didn't really explain it, right? So implied volatility is the expected move that people are paying for, like in this option premium, by the time of expiration, right? So implied volatility is saying, okay, like I think that there's going to be a 14% move in 40 days. That's what people are willing to pay. Now, historically, volatility is never as high as implied volatility on average, right? So it makes sense to, in the long run, be selling options, because if people are willing to pay for this implied volatility, but it's not actually going to happen, that's a clear mispricing. That's honestly the simplest thing. So implied volatility is just the implied move of what people are willing to pay, which is also why, for instance, let's go on to some stock that's going to have earnings, right? So we'll look at upcoming earnings. And sure, let's go to AutoZone. Unless this is a super, yeah, all right. That stock is not going to be a great stock because the dollar amount per share is going to be a little off the charts. So let's go to Centage. Yeah, Centage is great. So you'll see that there's more implied volatility right before earnings because that type of event is going to push the stock in some definite direction that people are willing to pay for, right? So if I look at, say, something 40 days out, right, I buy a call, implied volatility of 25%. Now, if I buy a 12 day, you'll see 36%, right? So implied volatility short term is a lot higher because what's spiking it? Well, earnings is spiking it, right? Because they're supposed to have earnings. Bear with me. Their earnings are the 24th, which is in 2 days. I believe that's going to be a Wednesday, right? So they have earnings this week. That's why their implied volatility is so high. And people are willing to pay for that. So thus, IV crush is a real thing. Once the move has happened, the IV is lower because the move has already happened, right? So this can really rattle how options perform after earnings because people will usually buy, say, calls or puts in anticipation for earnings to beat or, not to beat, like a miss. And the options will actually not be in as much profit as they thought they would because nobody's bidding on those options anymore to the degree that they were because the move has already happened, right? So I like to sell when implied volatility is elevated on stocks. Now, not going crazy, but anything around like a 50 IV is pretty awesome. Even up to like a 60 or 70, like for instance, like a lot of people are hot on the stock SoFi right now, right? Whether it's a good buy or bad buy, we could talk about later. But just to drop down and say I'm selling a put on SoFi to, get into SoFi, make some passive income, if you will. We'll go down to the 30 Delta. You can see that it's a 70 implied volatility, but that also makes sense because this stock is up all and around. And honestly, people are just really bullish. They don't really know where it's going to go, but people are willing to pay a lot for those options, right? So that's why the IV is super high. So yeah, and honestly, we can ignore this. It's kind of just fluff, but people are going to want to sell when IV is a little bit higher. Like for instance, UPS is going to be something, or even like Coca-Cola is going to be something with a much lower IV because the stock just kind of goes flat. So thus, my guess is that Coca-Cola probably has like a 28% IV, if I had to guess. It's not a great expiration. Selling a put, my guess is a 28, but let's see. 19 or 20. Because a lot of people are not bidding on these options like they would SoFi because the growth just really isn't there, right? So that is the last Greek. So again, watch these videos back if you need. But other than that, we'll be moving on to our second to last module of just kind of the core strategies, reinforce those when using options. So I will see you guys in the next video.